Welcome back. So you've decided to buy a house. Fantastic. But before you start picking out your paint colors, let's talk about your finances, specifically your credit score. Think of it as your financial report card, and spoiler alert, your lender is your teacher. So let's dive into what you need to know to get pre-approved for your mortgage.
You are now listening to Search to Sold with Matthew M.G. Garcia.
Money talks, but first, it yells at your credit score. Understanding your credit score. Your credit score is a 3-digit number ranging from 300 to 850 that reflects your credit worthiness. Lenders use this score to determine how risky it is to lend you money. The higher your score, the better your chances of securing a favorable mortgage rate. Credit score requirements. Let's break this down as it relates to different loan types and what credit scores are going to be required. This is to serve as a general template, and this could always change, but let's get into it. Conventional loans typically require a minimum score of 620. A score of 740 or higher can help you secure better rates and lower down payments. FHA loans. These allow for lower credit scores. A score of 580 or higher qualifies you for a 3.5 down payment. Scores between 500 and 579 require a 10% down payment. Keep in mind that these are, again, general guidelines, and you have to talk to a lender to get more details on how these things may vary. Let's talk debt to income ratio, DTI. Your DTI ratio compares your monthly debt payments to your gross monthly income. Lenders use this to assess your ability to manage monthly payments and repay debt. A DTI below 36% is ideal, though some lenders may accept higher ratios depending on other factors. Point is, talk to a lender and they can break this down for you as it applies to your circumstance. And they will, a good lender, I should say, will meet with you to do these consultations and to do these meetings and help you figure this stuff out for free. The pre-approval process. Getting pre-approval shows sellers you're a serious buyer, and here's what you'll need. You're going to need proof of income, which means recent pay stubs, W-2s, and tax returns. You're going to need your credit history, and let's talk about this for a little bit. Okay, I wasn't going to get fully into this, but we're here, you're listening, so let's go. I start at pre-approval because there is another thing called a pre-qualified that sellers don't really take serious. Basically, what a pre-qualified is, a pre-qualified letter is, it's a credit check, and it sometimes doesn't even pull on your credit. It sometimes can do a soft pull, but it's based on whatever you tell the lender and the information that you provide. There's no verification of anything. That's why it's hard to take this serious and to put you in the box of a serious buyer, which is what the sellers are going to be looking for when they're sifting through the deals. It's a general estimate. It's not verified. So keep that in mind. I don't do that. I don't recommend clients have that. So what I start with is the pre-approval. And the pre-approval, you're going to have a hard pull on your credit score. This involves income verification, bank statements, tax returns, etc. It's way more reliable and it's stronger than a pre-qualification, and it's kind of why it's the bare minimum at this point to make your offer competitive. Now, let's talk about the hard pulls real quick. Does it impact your credit? Yes, but because of the FICO guidelines, what happens is they allow multiple mortgage inquiries within a 14 to a 45-day window. And that varies by scoring model, but it can count as one inquiry when they kind of see that you're shopping for a loan product. Best practice, and again, talk with your lender to get more specifics. This is just general guidelines, but best practice may be trying to shop for that loan product within the 2-week window just to minimize score impact. And the third and final option, which is the best option if possible, is to actually get a loan underwritten. And it's going to be a credit check and it's going to be a hard pull. And that's already part of your pre-approval process, and that rolls into your underwriting process anyways. So the underwriting involves a deep review of financial documents and risk assessments. So a client has already been pre-approved, if a client has already been pre-approved, no additional hard pull is typically needed unless there are delays or a second lender is involved. But that being said, there are scenarios where you can go to the table with a loan underwritten, which is stronger than a pre-approval, and now you're just waiting on the property that you need that loan for. Employment verification. Confirmation of your employment status. What they're going to be looking for is 2 years of history. And that also would include if you have been in school for the last 2 years. That actually can play a role and factor into your qualification. So make sure you ask your lender about that as well. And then they're going to look at asset information. They're going to ask for your bank statements and investigate your account summaries. Once you're pre-approved, you'll receive a letter stating that the loan amount you're qualified for typically is valid from anywhere from 30 to 90 days, depending on what the specifications are of that approval. And I will say this, that is a big range, and some lenders have told me that if in the process of searching for a home, they need to update that, they will work with you to try to get you an updated version as it may be needed. Tips to improve your financial standing. Okay, let's enhance your mortgage eligibility. And again, if you meet with the lender, this is something that they can help you actually strategize for and put a timetable together for you as well. But you're going to start with checking your credit report, and you're going to make sure that there's no errors on there, because if there are, you're going to have to try to start fixing those errors and make sure that only the accurate information is being reported. You're going to want to start working on paying down your debts. You're going to lower your credit utilization ratio. That's the fancy way of paying debt off, paying some of those debts off. You're going to want to avoid new credit lines. Opening new accounts can impact your score. This is not the time for that. And you're going to want to start saving for your down payment if you haven't already. The more you can put down, the better your loan terms may be. In our next episode, we'll explore how to define your home buying criteria, separating the must-haves from the nice-to-haves. Stay tuned.